Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 2 of Futures Contracts 101, we'll cover the advantages of trading futures, the potential risks, and a step-by-step guide to placing your first trade. The learning curve for new traders. Futures aren't stocks. The mechanics, expiration dates, contract roles, basis risk, add layers of complexity. New traders often stumble on rolling contracts. Forgetting to switch to the next expiration can force unwanted deliveries. Order types. Stop limits versus market orders behave differently in fast-moving markets. Tax quirks. Futures use a 60/40th tax rule, not the usual capital gains rates. Paper trading helps, but real money feels different. Start small. One bad trade with too much size can end your futures experiment early. The risks aren't reasons to avoid futures, they're reasons to respect them. Plan your trades, manage your margin, and never risk money you can't afford to lose. How to start trading futures. Ready to dive into futures trading? The process is straightforward, but skipping steps can cost you. Here's how to get started, from picking a broker to placing your first trade, without the guesswork. Selecting the right futures broker. Your broker is your gateway to the markets. Not all platforms are created equal, so look for these key features. Low commissions and fees. Some brokers charge per contract, while others offer flat rate pricing. Compare costs before committing. Reliable trading platform. You need fast execution, real-time data, and intuitive tools. Test demo accounts to see what feels right. Margin requirements. Brokers may ask for higher margins than exchanges require. Check their rules to avoid surprises. Customer support. When trades go sideways, you'll want help fast. Look for 24/7 phone or chat support. Popular choices include TD Ameritrade, Interactive Brokers, and NinjaTrader. Start small, you can always switch later. Building a trading strategy. Jumping in without a plan is a recipe for losses. Your strategy should answer 3 questions. What's your goal? Are you hedging risk or speculating for profit? Know this before placing a trade. Which markets fit your style? Day traders love liquid markets like E-mini S&P 500 futures. Swing traders might prefer gold or crude oil. How will you manage risk? Set rules for position sizing. Never risk more than 1-2% of your account per trade. Stop loss orders. Automatically exit losing trades. Profit targets. Lock in gains before the market reverses. Test your strategy with paper trading first. Real money feels different, but practice builds confidence. Placing your first futures trade. Time to execute. Here's the step-by-step process. Fund your account. Transfer enough to cover margin requirements plus a buffer for volatility. Choose a contract. Pick an asset and expiration date. Near-month contracts are most liquid. Decide long or short. Buy if you expect prices to rise, sell if you predict a drop. Set your order type. Market order. Fills immediately at the current price. Limit order. Fills only at your specified price or better. Monitor and adjust. Watch your trade, update stop losses if needed, and close manually or wait for expiration. Most platforms show an order confirmation before finalizing. Double-check details. Entering the wrong contract month happens more than you'd think. The first trade is nerve-wracking, but it gets easier. Stay patient, stick to your plan, and avoid overtrading. Futures move fast, but discipline keeps you in control. Advanced strategies for futures traders. If you've mastered the basics of futures trading, it's time to explore advanced techniques. These strategies aren't for beginners, but they can sharpen your edge, whether you're hunting for steady gains or exploiting tiny market inefficiencies. Let's break down 3 powerful approaches. Spread trading, calendar and intermarket spreads. Spread trading involves taking opposite positions in related futures contracts to profit from price differences. It's less risky than outright speculation because you're betting on relative moves, not absolute price swings. Calendar spreads. Buy and sell the same commodity with different expiration dates. For example, go long on December wheat futures while shorting March wheat. You profit if the price gap between contracts narrows or widens as expected. Intermarket spreads. Trade link but different assets, like crude oil versus natural gas. If oil prices surge, natural gas might lag, creating an opportunity. The key: understanding seasonal trends, supply cycles, and historical relationships. Spreads won't make you rich overnight, but they smooth out volatility. Arbitrage opportunities in futures markets. Arbitrage is the art of exploiting price mismatches across markets. For futures traders, it means locking in risk-free profits when prices get out of sync. Here's how it works. Cash and carry arbitrage. If gold futures trade higher than the spot price plus storage costs, you buy physical gold, sell futures, and pocket the difference at expiration. Index arbitrage. When S&P 500 futures diverge from the actual index, traders buy the cheaper one and sell the pricier one, forcing prices back in line. Arbitrage requires lightning-fast execution and low fees. Most opportunities vanish in seconds, so only high-tech traders or institutions can capitalize consistently. Algorithmic and high-frequency trading. Futures markets move fast, and algorithms thrive on speed. These automated systems scan for patterns, execute trades, and manage risk without human hesitation. Here's what they do best. Trend following. Algorithms identify momentum and ride it until signals reverse. Market making. Bots post buy, sell orders to profit from bid-ask spreads, adding liquidity. Statistical arbitrage. Math models detect tiny price anomalies between correlated assets. You don't need a PhD to run algorithms, but you need robust backtesting. Bad code can lose money faster than a human ever could. Most retail traders use pre-built platforms like MetaTrader or TradeStation before coding their own. One warning. High-frequency trading is a shark tank. Firms with expensive tech fight over microsecond advantages. Unless you're ready to invest in infrastructure, focus on slower strategies. Each of these methods demands practice, but they unlock new ways to trade smarter. Start small, study the details, and scale up as you gain confidence. Futures trading opens doors to markets many investors never touch: commodities, indexes, and even interest rates. The leverage, liquidity, and flexibility make these contracts a favorite for hedging and speculation alike. But remember, the same features that amplify gains can turn minor mistakes into major losses. Key takeaways. Start small. Master margin requirements. Test strategies in simulated markets before risking real capital. The learning curve is steep, but with patience, futures can become a sharp tool in your trading toolkit. If you're intrigued, keep exploring. Read market analyses. Watch how prices react to news. And most importantly, stick to a plan that fits your risk tolerance. The markets aren't going anywhere, so there's no rush to jump in unprepared. Ready for the next step? Open a paper trading account and practice without pressure. The best traders treat every trade as a lesson. Will yours start today? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.